However, now there is a however.
Hi guys, thank you so much for joining me in another video. Today I wanted to speak a little about behavioural investments. Not the airy-fairy stuff, but what really makes our brains click as individuals that sways us into the mood to part with our cash or not. I did come across a fascinating read this week, which was understanding how removing friction and obstacles can make us better long-term investors. It's something that I am familiar with already, with so many investing and personal finance writers, bloggers and the like who advocate for a simple, automatic route to investing. If we want to encourage an action, we have to make it simple, whether that's trying to encourage my 2-year-old to eat up her carrot, and likewise, if we want to make an action difficult, we put up obstacles. And that's the simple way of manipulating behaviors, and it's a human trait whether you like it or not. We know this innately, so when we are trying to eat healthy, like my husband and I, it's a bit silly to have cookies in your snack cupboard, chocolate in the fridge, and Ben & Jerry's cookie dough ice cream in the freezer. And these are just a small array of problems I'm having to personally contend with right now. However, we understand that having some resistance can have a profound impact on the consequence of the actions we take. So here in the UK, the imposition of deaths by paracetamol overdosing fell by 43% simply by the manufacturers reducing the number of tablets in a packet. It does seem quite crazy that such a simple and elegant change could have such an impact on decision making and an almighty benefit to society as well. But it's true, that's how it works. And likewise, when behaviors are driven by emotions and moments, even minor amounts of friction can exhibit incredible leverage and manifested moments. So think about those times when you felt the need to road rage. This, what I call a tick of human psychology, is important for an investor to understand, as it matters a great deal. But why does it matter so much? Well, we've talked before about the democratization of investing platforms, the technology, the advancements in data and information, and also the nice chunks of tax allowance that allow us to invest. So our favorite YouTubers and bloggers also know this, and so we are awash with information and stimulus and have the freedom with these new platforms to transact at any given moment. And we can trade in the markets that are open 24 hours a day, with everything being so seamless. There's literally no friction at all. I'm not one that's going to go around chastising the developments, because it's great. The transparency of information and control we now have make it easier than ever to invest and create meaningful wealth to secure our financial futures. However, now there is a however. We have to also recognize that with the freedom to transact at any moment, there are also some externalities, and that's my technical term of the day. What are externalities? So it is a consequence of, say, an industrial or commercial activity which affects other parties without it being reflected in market prices, such as the pollination of surrounding crops by bees kept for honey. And with the absence of friction, it allows us to easily make investment decisions based on how we feel at that moment in time, and thereby exacerbating those negative investing traits which dog the performance now. So chasing, market timing, panic selling, all of those things that make me super anxious as an investor. Likewise, those traits that make sense for long-term investing, such as deep analysis and simply having a long-term investment horizon, are more difficult to come by. What's more, friction investing itself has a bad image, and we don't personally want our decision-making slowed down, right? And it's that perception that it makes us unable to act on opportunities as they arise, and so suppressing our best ideas, our instincts, our intuition. And sorry to burst that bubble, but it is a little bit silly, really. So for the vast majority of investors, the ability to react fast and exploit near-term opportunities is a danger, not really an advantage. I do think only a select group will attempt such an activity with success as well. The majority that do will actually get burnt, so will be distracted and at best be an irrelevance. I've kind of been there, and it's a hard truth to swallow. While we may perceive friction as a hindrance, even the definition of the word makes it sound like a hindrance. It can quell some of our worst dispositions and promote a longer term investing approach. So friction is not supposed to stop us making decisions or to stop us investing. It's definitely not a prohibition. As the term implies, it is there to slow down the decision-making process. It introduces time and reflection. Now, if I go out shopping on the fly and I really like something but I consider it as a big purchase, I try not to buy it there and then. If I think about it the next day, then I actually think about buying it. Now, it's probably true to have some rules that are prohibitive. So for me, that's don't trade FX, don't day trade, and don't stock pick foreign stocks, for instance. However, in most cases, it is prudent to have some delay. For instance, you might have a screening process which will all have a significant ramification for the decision-making process. And as private investors, we often think about friction as traps, not being able to sell a poorly performing fund or position because the FOMO mentality or that it cannot possibly go lower is an example. Likewise, not selling a position which has peaked for you. And that's true, but not the point I was trying to make, which is that friction helps. It is easy to get out and hit the reset button, really. How do we become better investors knowing this? So in order to become better, we should think about our own inhibitors, which would include how often you check your portfolio. And that's pretty hard, right? Restricting the number of trades that you make might be another example. And another one is making it a little bit harder to log into instant trading apps. That's hard as well. I'm pretty transparent with my approach. I invest consistently in passive funds. However, my stock picks only trade once a year in November. So it doesn't matter what's happening to them. And as time goes on, I'll probably check the positions a couple of times a month. So there's only 2 months to go there. So I'll be doing an update on that. And maybe with all the scrutiny that trading platforms are going through at the moment, it may make sense to have those inhibitors for users to delay trading. For instance, an order sits on the platform for a few days before being executed. I don't know what the technicalities of that are, but it's unlikely. And where's the thrill in that? The endorphin rush of scoring a trade, which looks more and more like a bet than an investment. And how do professionals do it? Well, they create friction, of course. They have an investment process, committees to discuss the investment ideas and dilute the views of one person in the hot seat, which is the fund manager. And that being said, that friction maintains faith in the direct. However, they also have the flexibility to be nimble, react to pressure, and take risks according to a dynamic narrative. So friction and fluidity work together in that case. So how do we end? Long-term investing has never been more difficult, and my battery is about to run down in any moment now. So let me get through this quickly. What I do want to say is that investing in the long term has shown undeniably that risk approaches closer and closer to zero as the investment time horizon increases. But doing less and being consistent and allowing compounding to work is as hard as ever, and of course it sounds quite simple and far from easy, right? So the more we are in the market, the more we are tempted to participate in the current party. So there you have it. Don't forget to like, comment, subscribe and all of that jazz. But until next time, cheers guys.